has started.
Good morning, everybody. We're going to welcome everybody to the June 25th Thursday meeting of the Center County Retirement Board. It's 11:08, and we're calling the meeting to order. Our first item for business is to consider approving the minutes of the prior meeting of June, get it here, my apologies, June 11th. Would there be a motion to approve those minutes?
So moved.
Would there be a second?
Second.
Okay, it's been moved by the treasurer and seconded by Commissioner Higgins. Any further discussion on the minutes? Hearing none, all in favor say aye. Aye.
Aye.
Aye.
Any opposed to the approval of the minutes? Hearing none, the motion is carried. Just to establish a quorum and where we're at, this is Mike Pipe. I'm here in my home in Belfast.
Dawn.
Colleen
Aye.
Kennedy. I'm here in my home in State College.
Mr. Higgins at my home in State College.
Jason Moser, controller at my home in Bellefonte.
Okay, and again, we'll hopefully look for Commissioner Dershowitz to join us a little bit later. So we do have a quorum and we can proceed. And we have no correspondence and no old business, but we will turn it over to our controller, Jason Moser, to do some introductions and tell us a little bit about where we're at with our PFM presentation.
Sure. Thank you, Mike, for that intro. And today we have Mark Amatoro, Managing Director at PFM Asset Management, and Catherine O'Hara, Client Services Senior Analyst at PFM. And they are here based on discussions of the Retirement Board. We enlisted their services to provide a study and overview of the total retirement fund for Center County. And they did go back, I believe, 5 years on that study from data that we provided to give a total broad overview of the retirement fund, not specifically and exclusively an investment manager by investment manager, but the fund as a total entity. I sent out the draft yesterday to everybody or to review prior to this meeting, and Mark and Catherine are going to go through that, and they'll be sharing their insights with us as well. So I'm going to turn it over to Mark now, and we'll hear their report.
Thank you, Mr. Controller. So just by way of introduction, Mark Amatoro, PFM. Been at PFM for over 15 years. As Jason mentioned, I'm a managing director at PFM. Thank you for the confidence in PFM. I understand my colleague, Dan Kozloff, is the current financial advisor for the county. So thank you for the confidence in leveraging PFM services on the financial advisory side of PFM. So I'm also a proud 1996 alum of Penn State University. So why doesn't Catherine introduce herself, and then we can jump right in.
Oh, good morning, everybody. Thank you, Mark, for that brief introduction. But as everyone mentioned, my name is Catherine O'Hara. I've been with PFM now for just about 5 years. Previously, before joining the ranks with Mark in our multi-asset class business, I worked out of our Harrisburg office within our general client service group. So have been with PFM for a little bit, and I'm excited for us to go through our analysis today and tell you all a little bit more about PFM.
Thanks, Catherine. I should mention I've been at PFM for 15 years, and I'm co-leader of our multi-asset class business, which is the business that manages county retirement funds, pension funds, etc.
And Mark and Catherine, welcome. Just before you begin with the presentation, wanted to note that Commissioner Dershowitz recently joined us a few minutes ago, and so we just wanted to welcome him, and we'll turn the floor back over to you.
Thank you, Commissioner Pipe. So I trust everyone has a copy of the PowerPoint in front of them. I'll refer to pages as I go through. Does that work for everybody?
Sure.
Yep, I'm good.
Okay, great. So again, I'm looking at the PowerPoint and I'm flipping to slide 3. On slide 3, we have our, and before I begin, actually, I just want to confirm the amount of time. Is it our hard stop at noon? I want to be respectful to everyone's time.
That is correct, yes.
Hard stop at noon? Okay. We will plow forward. So key observations. This is a summary of all the key observations that we're going to communicate over the next 30 or 40 minutes. The first one, absence of total fund investment advisor. So from a governance standpoint, Center County does not leverage a total fund investment advisor. As you know, you hire 3 money managers, but there's no one at the total fund. There's no professional at the total fund level overseeing the fund. And that's an anomaly in the county space and in the municipal space, for that matter, across the Commonwealth and across the country, for that matter. Usually, there's an investment advisor overseeing the money managers. We'll get into that later in our remarks, but that's a critical component of this analysis. One of the key things is the total fund investment advisor would roll up total fund returns. We had to recalculate those total fund returns on your behalf, which you'll see in a second. But as a retirement board member, it's one thing to understand how the individual managers are doing, but it's very critical that you have a feel for how the total county retirement fund is performing relative to a benchmark and also relative to your actuarial assumption of 7.5%. And that was absent from the analysis that we absent from the returns that were provided to us. So we had to recalculate those, and we'll get into that in a second. The investment, and please interject with questions as I go through. Again, this is a summary slide. I'm going to dive into all these points in greater detail during my remarks. Investment policy, we found it to be restrictive in nature. What does that mean? One example is we noticed that you're not able to invest in high yield bonds. High yield bonds have done really well going back, and we'll share that with you. Portfolio, we believe your portfolio lacks diversification. What does that mean? We do not see a dedicated high yield manager. We do not see a dedicated emerging market equity manager. We don't see any publicly traded real estate. Those are just some examples to potentially further build out the diversification of your plan. Index funds, there's 0 index funds in your plan. PFM is a big believer in driving down costs wherever we can. We'll have a lot of remarks about index funds as we go through our presentation, but right now you leverage 3 active managers. A good way to save costs is to utilize index funds in certain asset classes, and we'll be discussing that moving forward. So performance, when we aggregated the performance at the total fund level, looking back, unfortunately, they've underperformed. They've underperformed the benchmark, and they underperformed peers. So by peers, we looked at how your returns compare to other public pension plans across the country, and we'll share that with you in a second. Moving forward, we took your asset allocation mix, so how much you have in domestic equity, international equity, and fixed income, and projected that out using PFM's assumptions. And it per our calculation, going forward over the next 5 years and over the next 30 years, with the simple portfolio you have today, it's going to fall short of your target return of 7.5%. Again, this is the summary. We're going to go into each of these points in greater detail going forward. If there's no questions, I was going to move ahead to slide 5.
Yeah, what we can do, Mark and Catherine, is if we do have questions, we can unmute and ask them, but you can feel free to just take it and run with it, and we'll jump in.
Sounds like a plan. Thank you. So slide 5 is your portfolio. Your policy targets are 65% in the equity markets, 35% in fixed income or bonds. That's fairly consistent with what we see across the Commonwealth, and it's fairly consistent with what we see across the country in terms of, defined benefit municipal, county pension funds. You have 3 managers, CS McKee, Twin, and Emerald. You have significant exposure to CS McKee. CS McKee manages about 75% of your county retirement fund. Your county retirement fund was about $101 million at the end of the first quarter. Moving ahead to slide 6, these are the targets in your investment policy statement. 45% to U.S. equity, 45% to large cap equity, 10% to small cap equity, 10% to international, and 35% to fixed income. Again, not drastically different than our clientele and other plan sponsors, but what was noteworthy in your investment policy statement were the restrictions, which I already mentioned, but to reiterate, the first restriction, we did notice that there's no ranges by asset class. What does that mean? So if you had a total fund investment advisor, usually that investment advisor would be able to tilt the portfolio based on their views within a range. So for instance, large cap equity against 45%, usually that'll be plus or minus 45%, say 15% around that target. So if the investment advisor at the total fund level was bullish on large cap equity, they will be able to move money to that asset class. So you have not 45, but maybe you have 50 or 55% exposure to an asset class that they're confident in going forward is going to do well. You do have ranges, but your ranges are at the manager level. So CS McKee has a range. I believe Emerald has a range. Maybe Emerald has a range or Twin. But if they view the world differently, they could be offsetting each other. One could be bearish, one could be bullish, and they offset each other. That's why there's value in a total fund investment advisor, because they control, how the portfolio is allocated at the total fund level and not just at the individual manager level. Another restriction we saw, which I mentioned already, below investment grade or high yield bonds are not permitted. Again, I'll show you returns, but high yield has performed really well. It can be a volatile asset class, so you don't want a lot of exposure there, but it's an asset class that's performed strongly looking back. You also do not allow alternatives, which again, maybe that's the interest of the board, which is fine. PFM is very, very cautious when it comes to alternative investments because they tend to be high fee and they're illiquid investments, but they're not permitted. So at least maybe there is a forum going forward for some education there, even if you don't want to invest in alternatives. So slide 7 is very important, and it may be one of the most important slides in the deck. So this is something that we had to calculate. We calculated this based on the weighted average of the quarterly returns from each of your investment managers. This is the total county retirement fund returns as of March 31st. So the one thing to notice, we all know about the COVID pandemic and the significant downturn in the markets in the first quarter. Yeah, you performed at negative 16% for the first quarter, negative 16.24. The benchmark was only down 13.5. So unfortunately, even though you had active managers, the active managers did not protect capital in the downturn, which is unfortunate. And so you underperformed the benchmark by almost 3%, which is a big deal on $100 million, obviously. It's $3 million. And if you look out, the 1 year number is now negative 6.8, also a 3% miss versus the benchmark, which again is unfortunate. You want your active managers to protect capital in a down market. And then the theme continues, the underperformance, 3 years, 5 years. We went back to 2015, as Jason mentioned, and the theme continues, underperforming by about 1% going back to 2015. Again, these returns are as of the end of the first quarter. So that's one way to look at it. Slide 8 gets into, okay, you underperformed the benchmark, but how are you doing versus your peers? How are you doing versus other defined benefit pension plans? If there is a red box on the bottom, that means you're below median. So take, for instance, the year-to-date column, the 92. That means you scored in the 92nd percentile. Another way to look at that is you outperformed 8% of your peers across the country. Unfortunately, that's not the score you're looking for. The 1 year column, 82nd percentile, means you outperformed 18% of your peers. And 3 year, you're right around median. But in this most recent downturn, you underperformed the majority of your peers, is the takeaway of this slide. Slide 9. So if you have one bad quarter, it's obviously going to impact your 1 year, your 3 year, etc. So I think it's also important to look at calendar year returns, because obviously if you have one poor calendar year return, it's not going to impact another calendar year return. But unfortunately, the same theme persists. Underperformance for 4 of the past 5 years, underperformance for 9 of the past 10 years. And we got these returns from your actuarial report.
And Mark, if it just on slide 8, when you talk about our peers, um, other counties in Pennsylvania, other counties of our size, other counties of our same portfolio size, what are we talking about?
Yeah, good question. So these are all public plans. This is not specific to the Commonwealth. These are all public plans across the country under $1 billion. So it's a huge universe. It's a huge universe. But in order to get a large population, you can see the population row on slide 8. You know, there's 300, if not 400 public plans in this. So we wanted to get the population high enough to give merit to the ranking, but it's not specific to the Commonwealth. It's across the country, and it's 300, if not 400 plans that are under $1 billion.
So this could be municipal, it could be police, it could be,
Yes,
it's anything public. Okay, thank you.
yes, yes. A good question. So moving on to slide 10, 10 shows you calendar year returns. We already looked at your calendar year returns relative to the benchmark, but how are you doing versus peers? Again, the peers being all public plans across the country under $1 billion. And you can see there's like 400, if not 500 plans that submit their data to this database that PFM subscribes to. Again, if you see a red box, that means you're below median. And unfortunately, you know, 2 of the past 4 years below median, 4 of the past 6 years below median. Moving on, 11 is an important slide. 11, so what you see in the green box is asset classes your county retirement fund has exposure to. What is outside the green box is asset classes you do not have a dedicated exposure to. So for instance, you do not have a dedicated high yield manager. You know, CS McKee tends to be investing in investment grade bonds, and they have to pre your IPS. But high yield, as you'll see in a second, has done really well looking back. You know, emerging market equity, you do not have a dedicated emerging market equity manager. You know, CS McKee might invest a little bit in emerging market equity in their international equity fund, but you don't have a dedicated emerging market equity, and same for real estate. And slide 12 is very busy, but bear with me. If you look all the way to the far right and you look at the column that says 2005 to 2019, and it says ANNN, that's annualized returns going all the way back to 2005. If you're at the top of that column, that means you're the best performing asset class. So large cap generated a return of 9%. That's been the best performing asset class going all the way back to 2005. Next, publicly traded real estate. Unfortunately, you do not have exposure there. Next is small cap. You do have exposure, but then the next two, emerging market equity, 8% return, high yield, 7% return. These are annualized returns going all the way back to 2005. And unfortunately, your county retirement fund did not have exposure, significant dedicated exposure to 3 of the top 5 performing asset classes. Slide 13. Slide 13 gets into your asset allocation relative to other public plans across the country, same population, public plans under $1 billion. U.S. equity, this has nothing to do with performance. This is how you are invested, you know, the weights in each asset class, not performance, the weights. So U.S. equity at the bottom, it says Center County, 58. So 58% of your county retirement fund is in the U.S. equity market. That's way above the median. The median public plan has about 39, if not 40%. International equity, you have about 5%. That's way below the median, which is about 13%. Again, that's actually been a tailwind. That's helped you. U.S. equity has been a good place to invest. U.S. equity has outperformed international equity, but it's just something to be aware of. You know, if you look further to the right, you'll see alternative investments. Again, you have 0. The median plan has about 7. Real estate, you have 0. The median plan has 10. Again, this doesn't mean it's right or wrong. This is just a data point and something to be aware of. Slide 14. So slide 14, we take your asset allocation mix between domestic equity, international equity, fixed income, and project out using PFM's capital market assumptions. So on the 50th percentile, which means, you know, the market doesn't go gangbusters up or down, we're expecting your portfolio to generate a return of about 4.7% over the next 5 years. Over the next 30 years, about 6.9%, which obviously is below your actuarial assumption of 7.5%. The next slide says if you further diversify your plan, and look at the 50th percentile row, those returns move up a little bit to 5% on the 5-year and 7.2 on a 30-year basis. One caveat, these numbers are a little bit conservative because of two things. One, this assumes all index funds. You can't model out how much active managers, how much incremental return you're going to get from active managers. So these numbers assume index funds. And it also assumes you don't use a total fund investment advisor that tilts the portfolio based on their views. Like I mentioned earlier, that's a big value add from a potential total fund investment advisor. If they're bullish on domestic equity, they're going to tilt the portfolio that way. And again, you can't model that. So again, these numbers tend to be conservative, but they give you an idea. Slide 16, I'm not going to go through all these numbers. You know that your funded ratio is about 90%. Your discount rate's about 7.5. More important is slide 17. Slide 17 in the chart, it's a pretty busy slide, but if you just look at the chart says your funded ratio currently is 90%. What this is saying is your funded ratio is expected to decrease over time. Over the next 10 years, it's expected to go down to 87.8. Why? Well, per what I just shared with you, you're not going to hit your actuarial assumption. If you're not going to hit your actuarial assumption, your funded ratio is going to decline over time, assuming you don't significantly increase how much you contribute to the plan. And that's, it's going to go down over 20 years to 80%, 30 years, it takes a big dip down to 66. It's just a compounding effect of not reaching your actuarial assumption. If you have a diversified model, the row below that, it does improve. Actually, your funded ratio improves in the first 10 years. And then it goes down to 88, and then it goes down to 81. Again, nowhere near as drastic as your current model. Again, we graph that on the bottom, but I think the numbers kind of get right to the point. Slide 18. Slide 18, the x-axis is risk, the y-axis is return. So if you plot on that red line, if your portfolio plots on that red line, that means you're getting the most return for the risk you're assuming. Unfortunately, you can see where Center County plots. It's not on the red line. That implies you're taking too much risk for the return you're generating. If you drag your finger up from the bottom, risk is about 11%. And then you hit Center County before you get to the red line, which means, again, you're not maximizing the return potential of the risk you're assuming. The diversified model does plot on the line. Again, that means you're getting the most return for the risk you're assuming. That was a lot of information. Now I'm going to transition into large cap domestic equity. So I'm going to move into individual asset classes within your county retirement fund. All that information leading up to now was at the total fund level. Slide 21. So you're aware you have two large cap managers, CS McKee and Twin. Slide 22, again, same theme. Look at the returns versus the benchmark first, and then look at it for the red squares, if you will. So CS McKee and Twin, like we already communicated on a year-to-date basis, both underperformed when the market sold off in the first quarter. CS McKee down 25%, Twin down 22%. CS McKee was in the 93rd percentile, only outperforming 7% of their peers, and Twin was in the 80th percentile, only outperforming 20% of their peers in the market sell-off. The 1 year period, same theme. Both underperformed the benchmark, -14, -10 versus -7, and both underperformed the median in terms of their peers. And I think you get the gist here. 3 year, same story. On a 5 year basis, CS McKee continues to lag the benchmark. Twin continues to lag the benchmark. However, Twin on a 5 year basis is outperforming the median manager. You see their peer ranking is 36. And CS McKee has been in your portfolio for a long time, so we include a 10-year number in. But again, the theme continues: underperforming versus the benchmark, underperforming significantly versus the median manager. And there's over 600 managers, 700 managers that provide the returns to this database.
And so, Mark, in terms of passive management in that slide 12,
Yep.
S&P,
Yep.
S&P median in all those categories.
Yep, and I'm going to have a slide. I appreciate that question, Commissioner. I have a slide on the index fund coming up, so I'm going to get to that in 1 second.
Sure.
Thank you for the question. So 23's individual calendar year returns. For the most part, similar story. 2019, they both underperformed the benchmark. They underperformed again in 2018, 2017. You have to go back to 2016 to see them outperforming the benchmark. And then the box again implies their peer ranking was below median for the periods you see there. 24 is, we just took a step back and looked at the holdings, and there's some overlap between CS McKee's portfolio and Twin Capital. So we thought this was noteworthy. So these names, I'm not going to go through all these names, but if you look at the top, Microsoft is 9% of CS McKee's portfolio and is 8% of Twin Capital's portfolio. Intel is 4% of CS McKee's portfolio, it's 2.5% of Twin Capital's portfolio, etc. So there's some overlap. These names represent 40% of CS McKee's portfolio and 26% of Twin Capital's portfolio. Again, just a data point, something to be aware of. 25 gets into risk. So now we talked about returns already. We're talking about risk now. If the box is highlighted, if the number is highlighted, that means it's not favorable. So standard deviation. How volatile is CS McKee's returns? Unfortunately, they're more volatile than the benchmark. Down market capture. You want the lower the number, the better. If it's greater than 100, that means you sell off more than the market does when the market goes through a sell-off period. So again, 123 is a poor down market capture ratio. And that theme continues for CS McKee over the 3-year, 5-year, and 10-year period. Twin, lower volatility than the benchmark. That's what you hire them to do, and a better down market capture than the benchmark. So now to the commissioner's question, slide 26. The 26. So, look at the banner. The banner says U.S. large cap equity utilize passive management to lower fees. So, PFM is a big believer in passive management within large cap equity. It doesn't mean 100% should be passive, but we think a good portion should be passive to drive down cost. Look at the peer rankings, as the commissioner already pointed out. They're consistently better than median. And that's what you're looking for. You're looking for median, if not better, if you're going to get an index fund, and that's what you get in large cap equity. Does that answer your question, Commissioner?
It does, thank you. And that's really what is driving a lot of the conversation, at least for me, is being aware and educating ourselves about the option of passive management and the philosophy that reduces fees and we still perform better than active management. So that's the philosophy that I'm operating with and hoping to consider and educate myself on. And so, yes, it answers the question. Thank you.
And the chart on page 26, this is Commissioner Higgins. Is that before or after fees?
That's just the benchmark, so there's no fees. The fees will be very, very small. So let's say 3, 4, 5 basis points. But no, there's no fees. This is just the index.
Right. So if this is the index, if you're comparing the S&P index to the actively managed, then that would even further, that would make the S&P look even better.
Yeah. Let me take back that answer that I gave. On slide 23, it says S&P 500. That's not fees. There's no fees taken out. On slide 26, it actually says S&P 500 index. So fees are, see, there's actually a note on the bottom of 26. I apologize. Index is net of fees because it says S&P 500 index. So this is actually the index return, not the benchmark, the index.
So this is that part's net of fees.
Yep.
Is the return from the universe of active advisors, is that also net of fees?
It depends if you look up above, it says, I'm looking at 26, it says IM US large cap equity, SA, CF, and MF. SA is separate accounts, commingled funds, mutual funds. If it's a mutual, so it's a little bit of a mixed bag, long story short. Right. If it's a mutual fund, it's net of fees. If it's not, if it's a separately managed account or a commingled fund, it's most likely gross of fees. So it's unfortunately a little bit of a mixed bag. We can rerun it and just do it versus mutual funds, and they would all be net of fees.
All right, I wouldn't mind seeing that because then you're finally comparing apples to apples.
Okay, yeah, we were just trying to get the population number up, but yeah, we can do that. So now we get into small cap domestic equity on slide 28. And this one I'm going to go through pretty quickly in the essence of time because performance has been pretty solid for Emerald relative to the benchmark, relative to the peers, except for, I'm on slide 30, except for calendar year 2016, very solid peer rankings. Slide 31, lower risk than the benchmark, a strong down market capture. So again, I'm going to move pretty quickly. 32, here we say PFM recommends a blend of active and passive management. Why? Well, we just saw, there's value to be had with an active manager. Emerald's been adding value above the benchmark. If you look at the Russell 2000 index on the bottom of 32, it's right around median, which is not bad. So you should use some indexing, in our opinion, here, but we don't propose 100% indexing here in this asset class. As you've seen in your county retirement fund, there's incremental return to be generated by a good small cap active manager. Moving on to 34, now we get into international equity. 35, very poor returns, unfortunately, versus the benchmark for CS McKee International Equity for all periods presented on 35, and very poor peer rankings on 35. 36, very poor peer rankings. Very poor performance versus the benchmark for 2019 and 2018, and peer rankings unfortunately below median for the past 3 calendar years. 37, volatility higher than the benchmark. You look at the standard deviation column, the down market capture greater than 100. So unfortunately, the risk statistics aren't strong. And then on 38, we say, we believe a blend of active and passive makes sense in this asset class as well. Why? Well, look at the ranking for the index fund for international equity. It's right around median. Over a 10-year basis, it only outperforms 35% of the universe, and over a 7-year basis, outperforms 44% of the universe. So more recently, it's been around median. Longer term, it's been fairly easy to beat. So we think getting a blend of active and passive management makes sense. Fixed income, you have one manager, CSB one. Decent. It's like benchmark-like performance, I would say, over a 3-year and 5-year and 10-year period on 41. The one slip up year to date on a peer ranking basis, adverse to benchmark. 42, again, very benchmark-like performance. Solid peer rankings on 42. One thing we noticed on 43, and maybe there's a good answer for this, we were unsure why you're using CS McKee's intermediate product. When we see one bond manager in a portfolio, we tend to see an aggregate product. An aggregate product just means longer duration bonds. And CS McKee does run an aggregate product, and you used to have exposure to it per the footnote on 43. It was switched in 2014. We show you here, not sure the switch really worked in your favor because their aggregate product outperforms a product that you have for all periods presented. Again, an aggregate product just means longer duration bonds, probably more volatility, but more return potential. And if you're a sole manager in a county retirement fund running a bond portfolio, you would think you would want longer duration, more diversification, and that's what you get in an aggregate portfolio. And again, that's what you used to have, but they switched out of it in 2014. We're not privy to what the rationale was. Slide 44. Risk statistics were poor on a 3-year basis, but fairly strong on a 5 and 7-year basis. 5 and a 10-year basis. 45, this is an important slide. We do not believe in indexing in fixed income. Look at the peer rankings over longer term, 5, 7, and 10 years. The benchmark is the index fund in fixed income has been very, very easy to beat. 71st percentile over 5 years, 83rd percentile over 7 years, 90th percentile over 10 years. So this is an asset class, as the title says above, is to utilize active management primarily. Doesn't mean 100%, doesn't be 100%, but it's been pretty easy for an active manager to outperform in this asset class looking back, putting aside the sell-off in the first quarter. So now we get more into qualitative information on the managers. Being sensitive of time, I'm going to move pretty quickly. I'm on 47. So I'm sure you're well aware of this. CS McKee sold the firm to a private equity firm and they retained about 12% of the equity. CS McKee did, is our understanding. Through this transition, there's been turnover at the firm. Chief investment officer, chief executive officer, 2 senior client service professionals. I think you're probably well aware of all that. In terms, we looked at the firm's assets back in 2012, they almost hit 14 billion. Today, if you look to the far right, they're about half of that. That's 7.6 billion. We include on the bottom the assets for the 3 products that Center County has exposure to. Large caps, 600 million. This is across all of CS McKee's clients. International is only 100 million across all their clients, and then 1.1 billion in the fixed income product you have exposure to. CS McKee has evolved more into a fixed income firm than an equity firm, I would argue, and you see that reflected in the asset values for their products. Twin Capital, a very small firm based on the western side of the state. They used to manage about $2 billion back in 17. Now with the market correction, they're down to about $940 million as of the end of the first quarter. The product you have exposure to, Dividend Select, has about $140 million in total product assets across their entire clientele. Emerald, based right in the Lancaster County area. Back in 2017, they were about $5 billion. Now they're about $3.5 billion. And the one thing we noticed, we're very familiar with all 3 of these firms. We're very familiar with Emerald. We're just not familiar with this product. It seemed like this was the only client that they had exposure to this small cap core product. We only see 10 million at the product level, so no other clients. So we were a little puzzled by that. When we see Emerald, we usually see small cap growth as opposed to small cap core. But again, the product's doing fine, but we just wanted to note that. Fees on 51, fees look reasonable. At the total fund level, the 34 basis points in the aggregate. I'll talk about the individual managers in a second, but at the total manager level, 34 basis points, I would argue, is competitive. When PFM builds portfolios, they're in that neighborhood of 30, 31 basis points. Wilmington Trust, you pay about 5 basis points for your custodian. So 52, not going to go through 52. This is just their fee schedules. Not going to go through 53. 54. So if you look down the CS McKee column, they charge 30 basis points on all the assets. And if you look to the far right, you see the peer median. Besides intermediate fixed income, they're below median, which is reasonable. Twin Capital at 35 is below their peer median of 53, and Emerald at 63 is below their peer median of 81. Hence my comment earlier. Wilmington Trust on 55. U.S. Bank is PFM's preferred custodian just because we get preferred pricing from them. No other reason. PFM is not a custodian, but they charge our clients 1.5 basis points. Wilmington Trust, we note on slide 55, they're charging you 4.5 basis points. So we just wanted to point that out.
And Mark, briefly on that, is that something that's regardless of who we go with, we have the freedom to do our own custodian?
Correct.
Okay. All right.
Yeah. When it comes to PFM is benchmark agnostic. And the one thing I should have pointed out, you pay 34 basis points on a weighted average basis on 51, but you're not getting a fully diversified portfolio. So is the fee reasonable? I would say yes. But is it a fully diversified portfolio for 34 basis points? I would say no. So I just wanted to add that context. Now we're totally switching gears, starting on 57. So if there's any questions on the portfolio, the managers, maybe you can ask them now, or I can continue. But now I'm switching into the model, the total fund investment advisor model, if you will. I'll continue going unless I hear questions. So, how should your retirement board best allocate your time? You may not have the most time to dedicate to this, or the expertise, or the structure to make timely decisions. So, a lot of institutions, a lot of retirement boards struggle with performance, which is what we just saw, or risk management, which is to some extent what we just saw in the analysis. So as the bottom of the page 57 says, working with a total fund investment advisor can allow you, the board, to focus on governance, oversight, and more strategic matters. 58. So again, I noted in my opening remarks that your situation right now is a little bit of an anomaly in the Commonwealth, in the county space. What we see in the county space is two models at the total fund level. One is a non-discretionary consultant, which is the first column, and the second column is a discretionary consultant, or is what's typically known as an outsourced chief investment officer. So these are the two models we predominantly see in the county space. I highlighted some in red just to get at some differences. So under the non-discretionary, the consultant gives you recommendations, and then you, the retirement board, says, yes, we want to hire Twin Capital. Yes, we want to hire C.S. McKay. You have final say. Managers come in. So if you say, yes, we want to hire a high yield manager, the consultant would need to bring in 3-4 managers to interview in front of you, and then you make the final call. Or if the consultant wants to increase domestic equity because they're bullish, well, then they need to recommend to you and get your approval at a meeting. It's different under a discretionary approach. Under a discretionary approach, the total fund investment advisor has discretion to make those calls real time. So if you decide as a retirement board you want high yield or you want emerging market equity, they have the authority to hire those managers real time without interviewing those managers in front of you. So they can hire them. They have that authority real time to build out a more diversified portfolio. It's more streamlined. Performance accountability, you could argue if you're a consultant, you're only given recommendations, so you're only partially accountable for the performance. Because at the end of the day, the client needs to agree. Maybe the client doesn't agree with your recommendations, and then you really can't point the finger at the consultant because the county didn't agree with the recommendation and they didn't follow through. Under a discretionary approach, there's no hiding. The discretionary advisor is on the hook 24/7 for performance. They have final say in managers in terms of hiring and firing and tilting the portfolio. So they're fully accountable. Clients' time, I would argue it's extensive under a consultant approach. Why? Because again, you would need to interview high yield managers, emerging market equity managers, real estate managers, and then make a decision. Again, under the discretionary approach, the investment advisor makes those decisions on your behalf. So 59 is fairly repetitive. I'm gonna skip it. 60 gets into kind of why have organizations moved to discretionary management. This is a survey we saw. A lot of them have moved to discretionary management because they don't have the internal resources to make those decisions real time, or they want better risk management, or they want additional fiduciary oversight, or faster implementation. Like take the COVID crisis. When the market sold off, they wanted an advisor at the pulse to reduce risk, to minimize volatility. So again, I'm moving quickly. I apologize, but I want to be respectful of your time. On 62, now we're totally transitioning, and we're going to take 5 minutes just to tell you a little bit about PFM, if that's okay. Any questions before I do that? Hearing none, I will continue. PFM was founded in 1975 in Philadelphia. We're privately owned. Dan Kozloff and myself are fortunate to be two of the 89 owners at PFM. PFM is laser focused in the public sector. You're well aware of PFM Financial Advisors. Dan Kozloff, that's the business unit that he works for, and he's currently your advisor for the county. Now, Catherine and I work on the asset management side of PFM. The highlighted box is multi-asset class. Again, that's the division that I co-lead, and Catherine's one of our team members. Every division of PFM is laser focused in the public space. That for the last couple of minutes. Over to Catherine.
Yes, as Mark mentioned, our focus within the multi-asset class management space is that advisor approach that Mark was explaining just a little bit earlier. And that's evident on slide 63 there, that within that $18.5 billion that we manage in our Mackem business, we actually advise on $12.3 billion with that discretionary approach. So that's really what we're known for in this space. And we've been doing that for over 25 plus years with a very consistent track record, strong performance versus the benchmark over a very long period of time. As Mark mentioned, we are 100% employee owned, and because of that, we are able to retain our fiduciary independence, meaning that we do not take custody of assets. We believe in following GFOA best practices of separation of duties, just because of transparency as far as fees, as well as performance. And then again, in line with that fiduciary independence, we do not engage in any what we call soft dollar fee arrangements with any third parties. we take pride in the fact that, as Mark mentioned before, that P stands for public financial management. So our sole focus is institutional clients. We do not advise any retail clients, so we can be very much attentive and vigilant to the needs and the special requirements that our institutional clients, and specifically our government clients, have. Our business was started in the East, specifically in PA, and we still maintain that dedication with 3 office locations, both in Philadelphia, Harrisburg, and in Malvern. Slide 64 really reiterates our commitment to the public space, and specifically the government space. That top line there, noting that 161 of our clients are in the government space. So it really speaks to a knowledge and experience that PFM is able to bring to the table that a lot of other firms are not able to do. As well as the other categories that are listed there, we do provide, again, that same OCIO discretionary approach. However, our bread and butter and our focus really still is rooted in the government space. And I think Mark has done a good job throughout this presentation noting our philosophy as we were able to dissect you all's portfolio, but PFM's philosophy remains that a diversified portfolio that includes both active and passive management, as well as dynamic asset allocation, is going to be the best approach for a risk-adjusted portfolio that consistently outperforms the benchmark. And that has been PFM's philosophy and what we still are committed to do today for our clients. And we use that word dynamic asset allocation. I think that's generally understood. However, the value that's added is what Mark mentioned earlier, is a little hard to model. So we like to show this slide 66, that really breaks down some of our asset allocation, our tactical asset allocation within our client portfolios. As you can see, there's not a lot listed here. However, if you take a closer look at 2020, we all know that we're living in unprecedented times. As Mark mentioned, having an advisor that is at the wheel 24/7, living, breathing, eating the markets, we are able to make those nimble movements that really emphasize downside protection, preserving our clients' capital. And that's summarized really well in that slide. And taking a look, you've had the pleasure of meeting Mark and I here, but as Mark mentioned, he is a co-leader with John Spagnola within the Philadelphia office, as well as my 3 other colleagues that are responsible for business development, as well as client service. And the really unique thing that we have with our team is the portfolio management, performance reporting teams, and within those exists our research team, as well as our investment committee. And so our research team, we have a dedicated team of 6 professionals that are charged with asset allocation, asset class research, investment manager interviews and research, and they do that hard, gritty work, really understanding each investment manager, bubble up that information to our investment committee, which averages about 35 years of experience, multiple CFA holders on that, and that is what we call our think tank for our portfolio. So we have really the best and brightest putting forth ideas for our clients. And not only that, those resources that our multi-asset class business brings to the table, we are supported by over 230 employees. I mentioned earlier that I used to work in our Harrisburg office with our concentrated client service group, but our Harrisburg office houses several of our centralized services, such as a client service group, as well as accounting and our trading desks for our short-term fixed income. And finally, looking at slide 68, we wanted to provide a sample of a lot of the things that we've been discussing today. Looking at, for example, a 65-35 portfolio, we like to show that, again, reaffirming our philosophy that a combination of both active and passive management can both be fee efficient and provide diversification that leads to consistent outperformance. We like to use the analogy of hitting singles rather than home runs. But you can see that with over 86% of our portfolios being dedicated to passive all cap managers. Again, reiterating that we don't think solely passive or solely active is the solution, but we do think depending on an asset class's efficiency, what managers or what investment style would be appropriate. Looking at fixed income, again, we see that that one is heavily actively managed. And so this kind of is the pinnacle of again, the analysis that Mark provided, as well as PFM's philosophy and approach to our clients' portfolios. And we wanted just to give you a visual of that. And so that is, and being again sensitive of time, I know I went through that rather quickly, but if Mark, there's any other comments that you have or questions from the board, we'd be happy to answer them.
Yeah, we want to be respectful of your time. I appreciate that, Catherine. And we're right at 11:59. So.
Slide page 68 is blank.
Is it really?
Yeah. So yeah, I think in the PDF that we have, it's blank. I don't know if either of you could do a quick screen share just to show that.
Yeah, I can do that.
Thank you.
Here we go.
Quick, guys, I did forward the PowerPoint just a moment ago.
Oh, you did? Okay.
Yeah, just a minute ago.
Okay.
Are you able to see my screen?
We are able to see that. Yes. Yep.
Okay, there we go. So that's slide 68. I think the Adobe, I've had that issues on other calls. I think the PowerPoint is just a easier way to read on certain desktops. But this is the slide 68 that we were discussing. So I'll just leave that there, and you guys let me know if you have any questions.
Yeah, and so the 30 basis points on the bottom is the weighted average fee for all these managers. So it's slightly lower than Center County. Center County, I think the number I recall was 35 in terms of total fund fee.
Correct. And this being fully diversified.
So I'll say this. Unfortunately, with this hard stop, I know the three commissioners have an event that we have to get to. That's we're going to be socially distancing and masking everything, but we have an announcement about our tourism grants here in Center County, and so we have to get to that. But I think it would be meaningful to schedule another time that we could debrief and ask some questions on this. That was a lot of information, 50 minutes of a presentation. So I would be in favor and agree with holding another discussion. I appreciate your time as well, both Mark and Catherine. But if you're available, if we can maybe schedule something offline for another block of time, that would be really helpful. If you're okay with that.
Yeah,
I think that's a great idea. Thank you.
we would love to do that.
Yes.
Okay, super. So we will leave it there, and again, as Jason mentioned, we just had the PowerPoint of that presentation sent out, so we can all look at that again. And we had the PDF sent out earlier in the week. But just a huge thank you to you both for the project you did. We again appreciate the opportunity to work with you and do some digging into where we're at. It's always good to have a fresh set of eyes look at this. And so again, we thank you. Anything else from the retirement board before we look to adjourn? Any other feedback?
No.
Okay. Again, thank you very much for your time. We really, truly appreciate this. And hearing no further discussion, we look for a motion at 12:02 to adjourn.
So moved.
So moved.
Second.
Either
Okay.
way.
Moved by Commissioner Dersham, seconded by Controller Moser. And all in favor of adjourning, say aye. Aye.
Aye.
Aye.
Have a great day, everybody. Thanks again.
Awesome. Thank you.
Thank you very much for your time.
Thank you
Thank
so
you.
much.